Hi, I'm David Shamansky with U.S. Mortgages, and I'm here to answer a bunch of frequently asked questions that we get on how we can help others that other people say no to, how we help you save money when you've got a low interest rate, how we help get you approved when other people can't, or get you your savings from a potential market correction that may be pending or looming down the road. Good question. So how does U.S. Mortgages protect your equity from a loss? It's very simple. We have made a partnership with an insurance company that allows us, AAA by the way, so they're not fly by night, not going to be gone when you need them, and they protect your investment, which is what your home is. I mean, yes, it's your place to live, but the reality is it's also your biggest investment you're probably ever going to make unless you sell it and buy a bigger house. So it protects that from the whims of the market. Anybody that's been around any length of time remembers 08, 09. Very clearly, people were losing $50,000, $100,000, $200,000 of their equity, and that's what this is designed to protect you from. You've worked hard to earn your money, you've worked hard, you've put money into your house, your home's appreciated. Those of us living in Colorado, across the country, but especially Colorado, have seen massive benefits from the appreciation from different businesses that have come in, etc. Why put that to risk? Why put it to risk? Because it would be akin to saying, I've got my stock portfolio that I put $100,000 into, and now the gains are up to $200,000. That's great, but if you don't sell that stock portfolio, your $100,000 gain, your 100% increase is only perceived. You don't have it yet. It's just digits on a piece of paper that may or may not be the same at the time you actually do decide to sell it. So what this does is it takes that from theory and puts it into reality. It takes your perceived equity and makes it concrete. So again, to lay it out easy, if your home was worth $400 when you bought it, and today it's worth $500. You've got a perceived amount of equity of $100,000 if you sold it today, and if that buyer paid you $500,000 for it. If the market turns by the time you're actually ready to sell it, that $100,000 could be gone. It could be higher, but it's also possible it could be less, and especially after what Colorado's been through, because we've had appreciation for darn near 10 straight years. At some point, there's going to be a peel back. And I have heard economists talking about even as soon as 2020 starting to see it. And the signs are there. And I'm not saying Chicken Little, the sky is falling, but I'm saying be wise. If you can protect yourself, why wouldn't you? You don't drive without car insurance. Hopefully you don't live, if you're married and have kids, without life insurance. Why have your biggest asset uninsured and unprotected and be subject to the whims of the market? Is a fixed rate better than an adjustable rate mortgage? I would say yes, but there are going to be people out there that could argue why an adjustable would be better. Let me tell you why I like a fixed rate mortgage. It's set, it's secure, you never have to wonder, it's easy to budget, and while you may have qualified for whatever it is, you're locked in on that for the 10, 15, 20, 25, 30, whatever term that you've set that loan for, regardless of what happens in the future. So let's say you're an 800 credit score, your job's great, life is good, everything's coming up unicorns and rainbows for you, fantastic. But that doesn't mean your life is going to be like that for the next 20, 30 years. So you run into a bump in the road. All of a sudden, guess what? If you're on an adjustable rate, you may not qualify to get into something new, and if the market has changed, your once great rate could be much substantially higher, and so now your budget is much more impacted because you're at the whims of the economy, and that can change depending on what the terms are of the ARM every month, every 6 months, every year. So how would U.S. Mortgages save you money because you've already got an incredible low rate? There's a multitude of ways to do that. First of all, let me present you with this as just a thought point. What if I marketed a 0% interest rate for you right now? How much business would I get? Tens of thousands? Like, almost every person in the state would be calling saying, I want the 0% loan. But what if all of a sudden the details came out on that loan and it was, you had to have that mortgage paid off in 12 months because you're 0% for 12 months and you got 12 equal installments to get that home. So even if you only owed $240,000 on your house, you have to be able to pay $20,000 a month to pay it off under those terms and conditions. Now the 0% may not be as appealing to you. And if you had a big balance, that may be unaffordable to you and you couldn't even qualify on it. So what we do is we look at the overall picture of it, where you're at today, but how can you best take what you've got and wrap it together. And one of the things that I've always told people is interest rate is key, but so is your life. If you are living your entire life because you're drowning in debt because you don't want to let go of some special interest rate that you've fallen in love with, where is the joy? Where is the benefit in that? There is none. But if you can take that same amount of debt and restructure it into a format that saves you $500, $1,000, $1,500, $2,000 a month, that gives you options. Options to either take that monthly savings and apply it towards your debt. Maybe you didn't need it. Maybe you didn't need to save any money. You make great money, your credit's great, there's no real reason. Well, there's a couple reasons you'd want to do that. A, it's smart and you will save money from it depending on your scenario. Maybe it's not applicable to every single person that is watching this or in this state, but the reality is the majority of them will get benefit from it. The other piece of the puzzle, or the other answer to that question, is if you could truly save money and don't, why? Why would you choose to spend more money than you have to? Many people shop all over. You can jump online and see all kinds of crazy offers. You know where the market is. Some stuff is believable, some stuff isn't. Why would somebody do that? Because they're looking for benefits, they're looking for savings, and sometimes you really just need to look at yourself and take a look at your complete picture and realize there's a better way to do things, maybe collectively, than everything being individualized. And we go one step beyond that because we're the only company that not only will do that for you, but ensure your equity as well, so that while we're at a peak or potential peak in the market, so your equity's at the all-time high point, or maybe you just bought your house, so that hard-earned down payment, you're happy that you're in your home, but you're a little bit nervous that if the market takes a turn, you may have to sell and you don't have any point of recovery because of all your asset was tied up in the down payment of your home, and your house has fallen in value and you've got to sell. You may be between a rock and a hard place, and with our equity protection, we can guarantee your down payment or equity from loss for up to 10 years for up to $200,000 on top of the money-saving monthly benefit that we can provide. Good question. How would we approve somebody when you've already been out elsewhere and they told you no? Many factors. First, let me say we're not magicians. So it's not like we're doing anything crazy behind the scenes. We're not going to fraud your loan. We're not going to make something that isn't what it is appear to be something different. We're going to take what you actually have and look at it maybe from a different perspective. Maybe it's an overlay that other lender had, or that other bank or institution had on you that is from themselves. And what an overlay is, just so I'm not losing you in all the nonsense jargon, is it's a condition of what the risk they're willing to accept. So I may be your lender that says, I will do your loan and I will give you these favorable terms and rates, but I'm not going to take anybody with less than a 640 credit score, or I'm not going to take anybody with less than a 620 or 580, or pick the number. It's not that they couldn't do the loan, they chose not to do your loan. So what we try to do is say, if there is a product or outlet that can benefit the borrower and our loan gives you a benefit and can help you out, why would we preclude you from that? So that in and of itself is number one, our priority anytime we're looking at a loan for anybody. So just because you may have been turned down, that by no means is a guarantee that you can't get a loan anywhere. It's just a guarantee that they won't give you a loan. You've got great credit, you don't understand why you got denied from a loan. That one is just as simple as the I don't understand why you could do something for me when somebody else couldn't. It's again the same guidelines, but this one's even a little bit easier because there's a debt to income factor. So credit score is important. Credit score is one of the pieces of the puzzle to put a loan together. And how we look at it in the lending, they call it the 3 C's, the 4 C's, depending on how old you are and how long you've been in the business. But it's credit, and it is debt to income, and it is your loan to value. Those are the 3 C's that come into what any normal old-fashioned underwriter would look at when they're looking at making an approval. And so you get into a compensating factor if it doesn't fit into the box, what have you. But when you're looking at purely score, let's say your score was an 840, which is at the absolute top of the spectrum, you would qualify for anything as long as you can service the debt. And again, I'll go back to what we talked about before, which was why would you care about protecting your equity? The market's going up, it's always going to go up, etc. It's not, but you know, that's a different piece. It's just because you could get a loan doesn't mean you're going to get a loan, because if you can't service it, if you can't show me that you've got the ability to repay that loan, why would I give it to you? So you've got an 800 score, you manage your debt well, you don't carry more than you can handle. But if you make $3,000 a month, guess how much money you can afford? Probably $2,000 at the absolute top end of the spectrum, because you've still got to have money coming out for taxes and you still got to survive. And in a real world, if I was going to say what is legitimately approval for you on a more of a broad basis, 50% is going to be about the top. So you really want to be at about a $1,500 payment. Can you buy a home for $1,500? Yes, it's possible, but you're very restricted on the type of home, at least in the Colorado market. You're definitely going to be geographically restricted in areas, and homeowners dues, association dues, taxes and insurance are also going to play a role in that, and that all encompasses what your total PITI payment can max out to be. So while you may be able to afford $1,500 a month, and while $1,500 a month, anybody can jump online and get a calculator and it says, oh, at $1,500 a month you could buy a $250,000 house or $300,000 house. Yes, if you didn't pay insurance, if you didn't pay taxes, if you didn't pay mortgage insurance, and if you didn't have any HOA dues, that would be a fact. But since all those other things do exist, you've got to account for that. And so now you've got to lower where you can actually buy to qualify for it. So 800 score, great, you're going to get a loan, assuming you can show the ability to repay. Hopefully these questions and answers are the ones that you would have been looking for, but if not, and you've got something more specific or something that wasn't covered today, please feel free to reach out to us so we can get your expressed concern answered.